Well, good morning, everybody. Welcome to this Thursday's GOAT Talk. I am excited to have one of our Sub2deals coaching students with us today, Mr. Frank Alcini. Frank is a CPA and a tax expert, and he's going to be talking to us today and sharing some tips with you guys on how to save money on your taxes. It's pretty timely this time of year. I know talking to Frank was a little bit back and forth this time because I know he's super busy right now. So Frank, good morning. Welcome to GOAT Talk. Tell us a little bit about yourself and what you do and how long you've been investing and all that stuff.
Okay. So I'm a CPA here in Michigan, work with investors from all over the country and concentrated on real estate activities and construction/rehab type activities, but been pretty much concentrated for probably the last 20 years of my career. Really, I think, William, as you know, I saw you posted the other day about a Carlton Sheets. I remember everyone saw that, those infomercials of the day in real estate, but it wasn't really until I got practicing in public accounting and started to notice my real estate investor clients really creating opportunities for themselves. Over the years, I've been invested passively in deals, actively, and in different facets of rentals and flips and different. So on the one side, I've been on the other side of my table of my clients and in their shoes. So understand dealing with contractors and some of that pain, or dealing with sellers of some distressed properties, but definitely enjoy working with investors and being an investor myself.
Oh, great. Sounds good. Hey, Cindy, good to see you. Cindy's first one on here. She actually asked a week or so ago, having someone on for taxes. So good to see you here. Well, tell me, Frank, you know, I guess the thing we want to kick off with some basic stuff here. What is the biggest mistake that you see most new investors making with their taxes or with their business in general that cost them money?
So really, when they're getting started, I think a lot of people look at real estate and I want to explore this, and I think early on identify whether they're going to pull the trigger or not. But the biggest thing is really not overcomplicating it, but also learning to run their business like a business, such as getting set up. But on the other side, I've had clients that have done many deals and come to me and have never even opened a business bank account, and now trying to get a handle on the last year of what they've done. Then other ones that have really gotten into that analysis paralysis. So come to me, they've got multiple entities and they've been learning for the last 3 years and have yet to do a deal. So again, a lot of good information, but definitely reach out, because really when you're getting started, you don't really know what's your learning process as opposed to your business. I know a lot of people will start out, do some marketing, and that's really going to be an advertising business. And on another note, when you treat your business like a business, you tend to be more successful also. So I'm not a big proponent of encouraging someone to overcomplicate it, but getting that business bank account, business credit card, and starting to act like a business is really that first step I like to see.
Right. So it sounds like to me what you're saying pretty much is that I know when I got started, I've always been, it's funny balancing being analytical with just wanting to get out and do something. I didn't know I needed an LLC and a corporation and do all of this stuff. I just went out and started buying houses. So the first 2, 3, maybe my fourth house before I said, whoa, I'd learned enough to know that I needed to restructure some things. But I did create a separate bank account and I made sure that I funded it and all expenses went through that. I bought my first 2 or 3 houses, made sure real estate was something that was going to work for me. And then at that point, we started setting up entities and doing that sort of thing. So is that sort of the recommended, don't worry about the LLC. People get so caught up in the, well, I've got to have the perfect business card. I've got to have the the LLC. I've got to have a corporation. Is it an S or a C? And they want to learn everything when what they really need to be learning is how to talk to sellers and buy some houses.
Oh,
And
yeah.
it's kind of like they worry about asset protection, but you need some assets to protect, then worry about that part of it.
Yeah, I mean, business cards, go out and get something so you can pass your info on. You can go get new business cards. They're cheap. You're going to waste more time than buying 3 different versions of business cards. You can pull the trigger and get that done, as opposed to spending months on that. But as you said, with the different LLCs, again, not a real proponent of that versus more separating your personal from your business transactions, because really the biggest thing people lose is when they come to me, that they've started a business and I say, well, what have you spent everything on? And they have no accounting of it. And as you've what's called commingled your assets, and your expenses, personal, how do I know that business meeting that you had coffee, William and I met, had coffee, discussed a Sub2 deal is different than when I went to go have coffee with my son, and that was a personal item. But again, as you noted, just having that separate account that you fund, that separate transaction, that's a great first start, because then from there, we can really identify what's going to be tax deduction and what's going to be something used in your business. If you can't tell me what you've spent, it's hard for me to tell you what deductions you're missing.
Right. Right. I
But
got you.
again, that certain entities and what you're doing are going to make sense under different scenarios. Are you someone who's flipping houses and making 100,000 a year, or are you making 2,000? Your situation is going to be different. Are you looking at Sub2 deals, or are you more of a buy and hold where you're buying with cash, or you're buying with a Sub2? So each situation is going to be different and warrant different types of entities
Right.
in that. So until you really get grounded on where you're going, because I think a lot of investors start out, everyone wants that passive portfolio, but a good flip or a good Sub2 deal that with a sale option, is really where you see the different opportunities.
Okay, gotcha. Hey, Matt, good to see you. We've got our first question. Hey, guys, if you're on here, drop your questions down here, hit the reaction button, give us a like or a heart or whatever we've got on this thing here. So Matt's got a question. Also, let me remind you guys, if you participate, if you comment, if you ask questions, you'll get the freebie. And we've got a really nice report for you today. That's 11 great tax tips to save you some money. That's for real estate investors. So make sure that you comment. Matt asks, do we need net 30, or is it okay to just sign up for a DUNS and apply for a credit card with your EIN?
So really establishing credit isn't a bad thing, and being able to get that. But sometimes I see people get lost in setting up credit, where with a business, especially with real estate related, if you're looking at future funding from that standpoint, it's going to be a deal by deal basis. Your relationship, is William going to loan me money on a deal? Well, he wants to know Frank. He wants to know my collectability, but you also want to know the deal. You might not loan me money on one deal, but you might loan me money on another, depending on how it's structured. But more on that operating expense and credit cards. A lot of banks, when you set up your business account, have more of an introductory as you're building that relationship. So on the one side, business credit's good, but really limits your protection in a worst case situation. And if you're structuring your business for that worst case situation, and as you mentioned, asset protection, you got to get some assets in place first. And sometimes getting started, you make that sacrifice on using my personal credit to get those deals under my belt to now get that private money, or wherever my business may go.
Mm-hmm. Okay. So back to expenses. Hey, Tammy, good to see Tammy. Tammy's from Atlanta. She's here with us today. writing off expenses. And I know, there's always the thing about the office deduction and this and that. And some people say that's kind of a flag for an audit and that sort of thing. What do you think is the most abused deduction? What deductions do you think are okay to take? Which ones do you think are maybe a flag to be audited that people really need to be careful with?
So a lot of times if someone's starting out, depending on what they're doing, the IRS runs into the hobby loss rules. So if you're an investor spending a lot of money looking at deals, never executing, and offsetting a lot of W-2 income, buying a lot of courses, it's going to really it's going to be facts and circumstances. But if you kept it simple and you never executed, then 2 years later you realize, I don't want to get into real estate, I'm going to call this quits. That's probably going to start to fall under a hobby loss rule. Now if it's something that I'm setting up a business, and the more formal you're going to get, the more of a business. But the biggest thing from specific deductions is automobiles. I wouldn't say necessarily abused. I think just not really understanding. Every time I drive my car, looking at a deal doesn't necessarily mean it's for business. There is what's called personal use. So I'm going to have business use and personal use. And then a lot of times I see husbands and wives get into real estate. Now they think every time they go out to dinner or meet that they're talking about business. So that's a business expense. Really starting to separate that. It's kind of like the old saying, pigs get fat and hogs get slaughtered. But again, I think don't get lost in that analysis paralysis. There's a lot of deals out there still. It's 2021 and great time right now, but educate yourself and learn, but get out there and get some deals too under your belt.
Yeah. So we've got a question. What are some of the most underutilized deductions that most newbies don't know about?
One of the things I see a lot of, you are getting started out and you have telephone, automobile, meetings you go to. William and I, which we're not going to meet for coffee. You're in Colorado, and but him and I meet. I buy him some coffee. We get together. He's out showing me some deals. A lot of those expenses are just the little ones that can add up over time. And I've had some successful clients that have gotten started, but really lose track of that, those startup expenses as they're growing their business, and think when they get their first deal, let's say I'm starting now in March, I don't get a deal until June, but I've got a lot of legwork in getting that deal under my belt. And a lot of those expenses being able to track are going to be related to getting that deal. Now, how you structure that deal, is it an investment, a flip, a sale, are going to be different on how they impact you and that. But that's where proper planning will be able to see what's going to make most sense. Are you a real estate dealer or a real estate flipper or a real estate buy and hold investor? They all have different impacts on your return, but really being able to capture that and getting that good accounting, whether it means separate accounts, as you mentioned earlier, and going from there.
Mm-hmm. Okay. So Joni asked, in what instances is it necessary to have an accountable plan? I'm not really sure I understand what that means. Maybe give us a little bit more detail in there. Kevin wants to know, I'm sorry, did you get that? Is that some kind of accounting speak I'm not familiar with?
I'm guessing maybe she's referring to like a health insurance plan, or maybe a mastermind accountable group, or I'm wondering if it's referring to accounting. So
Joni, give us a little bit more clarity on that, and we'll come back to that one. Kevin asked, isn't it difficult to establish business credit with your EIN if you originally started with your personal credit, your Social Security number? I didn't find that to be the case personally. I mean, I was able to establish business credit after a few years of doing business. I mean, and it's just like any other credit when you're getting started. You just, you fire out applications to different business credit card type things, and some will approve you and some won't. So that was my experience. What about you, Frank?
yeah, lot of times getting started, and depending on the scale of the deal, you might even have business credit that sometimes you have to personally guarantee. So transitioning to business credit is going to help establish that. And not necessarily the credit, but that relationship. Whether it's a banking relationship, you might start to establish that, and they'll be there on that next deal that you have, and that's going to really pay dividends, having those relationships out there.
Cindy asked, my existing QuickBooks chart of accounts is not accurate for my business. How difficult is it to incorporate a new correct chart of accounts since I am up and running with multiple checking accounts and dozens of classes? Cindy, if you're not familiar with her, she flips, she seller finances, she does, a ton of different, she runs Airbnbs. So she's all over the place. So how difficult would it be for her to set up something for all of her businesses?
So within QuickBooks, so I always encourage clients to use different QuickBooks files for different entities or /EINs. If I'm doing a tax return, client has 3 entities with 3 different tax returns. I like to see 3 different QuickBooks files. You can use classes and track the different entities, but first off, from an IRS standpoint, you're using one accounting system, and to really get a balanced accounting system, someone who's familiar and sophisticated enough to do that can probably just have 3 separate files. But by having those separate files, you're going to be able to run the books and records of one company without sharing the other. Where if I was looking to invest in one of her businesses and she shared one with me, I'd really see everything else she had. But by keeping them separate, it would definitely help. But as far as updating the chart of accounts, might need some QuickBooks maintenance. Generally, it's pretty easy. Might be cleaning up and merging some accounts or adding some additional ones. Usually, if it's changing the history, though, I discourage against that. So for instance, within QuickBooks, you can set a date closing period. So I could effectively, once I get last year cleaned up, lock the date down as of last year, and then make sure that any changes that I do don't impact anything. Because the worst thing is when I go wrap everything up and then a client goes in, starts changing last year's records, and then the balances from equity roll forwards don't agree, and I'm trying to I spend more time chasing that check that you avoided from 2 years ago, as opposed to doing it the way QuickBooks is a little unique compared to some accounting systems, and the way you avoid old transactions and stuff.
Mm-hmm. And this might be a good time to let you guys know, Frank, in addition to being a real estate investor, he also does business with real estate investors by way of being their CPAs all across the country. And he was telling me before he got started, he has clients actually in several countries around the world. So how can they reach you, Frank, to set up a time for that free 20-minute consultation that you offer?
So the best place is go to my Facebook page, search for my name, and then REI Tax CPA. And there's a book now that'll take you to my scheduler, and it lets you pick a time. I've got some times available, and then gives you an opportunity to put a question in, helps me have an idea, and then I can sit down and then be prepared, and we can go from there.
Yeah.
But it's a great way to connect, and a lot of times I get connect with me on Facebook and go from there.
All right. Hey, Sam, good morning. Yes, everyone's looking fresh today. Like I said, we just take a page from your book. Cindy, follow up to that, says she has an S corporation with multiple LLCs. So I'm not sure if that's if you just want to talk to her about that structure, she can give you a call and talk to you about that. Uh, Matt says, let's see, his question, does it matter if our active income is separate from passive? Can we put both incomes in a series LLC?
Yes, you can. But with real estate, you have to understand everything. Real estate is parcel by parcel and different. Where I might be with the tax code, everything's identified at the taxpayer. The taxpayer means Frank, the entity. I might be a flipper, a buy and hold investor, a long-term investor, a sub-2 investor, but using those different entities, I can really start to establish what I'm doing. I might have a situation that I rehab 10 deals a year, but then I have an area that I buy rentals in. Have any of you ever had a rental you were rehabbing, you put a tenant in, a month later an investor knocks on your door and wants to buy that property? I'd really rather that be treated as a short-term capital gain as opposed to being commingled with my flipping business because of the ordinary income tax rates and the self-employment taxes. Um, if depending on the scale, if my investment LLC were to purchase that property, that I was going to, with the intent when I bought it to rent out, improve and rent, but William knocks on my door and gives me a fair price or a great price and wants to buy it, I'm going to sell it. That would be what I would call a capital gains transaction, as opposed to a property that I bought with the intent to improve it and sell it on the retail market as a flip. If I'm doing it all within one commingled entity, the IRS is generally going to take the position of what suits them the best. I'm a flipper when I make money, and I'm an investor when I lose, so that my loss is limited to $3,000 of short-term losses. So usually when someone says they're buying a property, I try to dig a little deeper. What's your intent? What are you going to do? Now, which entity should own that? And so that's why I like separate entities, as opposed to one entity. It could be Frank's flipping and long-term rental. Now, depending on the numbers I'm doing, I could start to commingle things and have some of my rental business turn into dealer sales. And that would really be the worst situation. So I want to be able to avoid that status.
Okay. We got Tammy from Texas here. She wants to know, can we deduct some educational expenses, for example, coaching, workshops, etc.? Absolutely.
Yeah. That's really really part of your professional education in your business, and that's why I always encourage clients from day one get that accounting done. So when you tell me that you've done coaching and education and really had different situations, we can get a handle on what you've spent and be able to deduct that properly. So again, how that's going to be deductible is going to be dependent on what type of business you have. Is it an investment expense or a business expense? And really understanding which lane you are in.
Okay. Rudy has a question about vehicles. He wants to know, what is an efficient way to separate and track personal and business use of the same vehicle?
So nowadays it's great. There's a lot of apps out there that I'll take a step back. The IRS always asks for a mileage log in an audit situation, that you claimed a few thousand miles, and you want to see that every weekend I worked on my rentals. Well, in the old days, a lot of people would keep day planners and track where they're going and add that up, and that's good. But sometimes people would put those together after the fact, and when they saw every weekend I went to my rental, but my credit card bill shows that I was down in Florida on vacation that week, they effectively don't just disallow that day's trip, they disallow the entire log. So nowadays, there's a lot of great apps out there that you can track your mileage and then assign it to personal or business. I actually have a client that had drafted a Google form, and she can enter her mileage on the form and it drops it right into a Google sheet. So when she gets in, but really being able to track that. So your commuting miles to your W-2 job aren't going to qualify, but then that's going to be your commuting. But when I'm going out looking at deals, I'm going to training events, networking events, driving back and forth to my flips, to my rentals. Those are all going to be business miles. Then we would look at, does actual versus mileage, the standard mileage rate make sense to deduct?
Okay. Hey, Phil, good to see you. Glad you're here with us. Nathan says, I have an S corporation. What are examples of valid fringe benefits that I can deduct? I've read all kinds of courses that have everything in there from just your standard deduction stuff to saying you can claim a commissary in your kitchen and all kind of stuff. And I know some of that, the crazier you get, the more likely you are to get a visit from the guy with the black hat. But so tell me, what are the best ones that probably will keep you out of trouble?
So with an LLC that's taxed as a partnership or a single member, generally the fringe benefits, the personal, are just going to be treated as owner distributions and that, and then with a or maybe a guaranteed payment if it's William and I are partners and I'm paying for benefits on myself. But then now, if you have an S corporation, there's going to be certain benefits that may, such as auto or health insurance, that might get added to your payroll that you're taking. But from the fringe benefit standpoint, depending on what you're doing, sometimes that C corporation, that's where that's going to come into play, in diversifying your entity. Again, if you're doing $5,000 a year of activity, it may not be worth having these different activities set up. It's hard to justify, but if I've got a strong flipping business, a management company, a sub-2 business, having that diversification out there is going to help. But as you said, a lot of times these, I've seen a lot of things that say you can deduct your kitchen because it's a benefit for employees and you work out of your house. If you're doing a lot of revenue, I guess maybe a second kitchen in your house could be argued that, but I've never seen it successfully. But if you were doing that much business, you'd have an office outside your house. I do have one client that their basement literally is set up. They've got multiple workers. There's not one personal thing in there, but turning 100% of your house into business is pretty tough. And the more aggressive you go, like you said, you're going to get a visit from someone you don't want to get a visit from.
Right. So Matt asks, how much does it cost to have a CPA like Frank?
Really depends. I like to work with clients. I work with clients annually, work with clients on a monthly or quarterly basis. So really depends, like to get an idea on what the client needs and then try to be able to quote something more on the front end. Sometimes it might just be time-based, but again, everything's based on time involved, and sometimes I like to be more proactive. I'd rather do that. And so that would mean having your books and records in a better condition so we can analyze them and provide some more proactive guidance versus just being reactive. And I have a little mix of both of that with clients, and it really comes down to the client. And but like to take care of them and work with them that way.
Yeah, Matt, go visit Frank's Facebook page and book that 20-minute call and talk to him about it there. Hey, Gail, I understand what you're saying. She doesn't have a tax question, but she wants the giveaway. So she wants to know how's the weather. It's actually pretty nice here. It's a little bit cool in Colorado. We actually had some more snow, I think, last night. I can't keep up with it, but how's the weather where you are, Frank?
Today it's starting to break and look like spring and get nice. Hopefully we're done with snow, but here in Michigan we always get a little snow. Sometimes mid-April we'll get something, but right
Yeah.
now it's looking nice. I've got short sleeves on today and didn't even wear a coat in from the car.
All right. So we got you covered, Gail. You're good. JC wants to know, can you talk about the tax break for primary residents sold within 5 years, getting a credit of up to $500,000 per couple? Is that still accurate or has it changed?
S- where's the question?
Primary residence, the tax break you get if it's been your residence 2 of the last 5 years, you get a
Oh,
500K tax break. I mean, no taxes on the first 500 for couples.
yes. If you've lived in it for at least 2 of the last 5 years.
Mhm.
So for instance, I move in my primary residence today. 2 years and a day from now, it appreciates $500,000, and I can sell that property and pay no gains on that transaction. This is where, and it has to be 2 of the last 5 years. Sometimes people in house hacking, and it's something with the way the market is right now, it's something to consider. Can I sell my old primary residence today or turn it into a rental? And I always walk through that with clients because 10 years from now, you've really not lived in it, even though and you've lost that 500,000 exclusion on that house. But
Mhm.
as far as I know, that's in play. That's been in play since 97, I believe, May of 97. And I know nothing of it going away in the future, but it's a great, powerful tool in a rising market to be able to upgrade or move around from property to property.
Okay.
Or aging investors sometimes looking at those nicer rentals. You might sometimes move into that nicer rental area and establish residency in there for a few years.
Right. Okay. Tony wants to know, he said he's interested in short-term rentals. Should he get a separate LLC for that business and keep it separate from his other real estate business?
So on the short-term rental side, a separate business may make sense. It really depends how you're structured, what your exposure would be. Not entirely sure what a separate business. If you've got a portfolio of rentals, you might want your short-term rental business separate. Again, down the road, if you have an established short-term rental business and maybe take on a partner or decide to partner up with someone, you might have separate tax returns that'll show that activity. So it wouldn't hurt, but from a liability standpoint, it might also help you on the protection side. But short-term rental business for simple purposes could be grouped with your long-term rental. But from practice, depending on if you're really scaling that business, it might make sense to separate the two. So either way would work. I'd have to say what's going to work best for him and what his longer term plan is. If it was one short term rental, I might just keep it in the existing rental business and go from there.
Okay. He's got a follow up to that. Is a series LLC the best for multiple short term rentals?
So from a tax standpoint, you're going to be taxed whether you've got multiple LLCs or one LLC. Really runs into that legal question, and I've got multiple attorneys I work with that have different viewpoints on this. I'm not an attorney, so not providing any legal advice. Don't sue me, but I have clients that have LLCs for every property, and largest client has over 100 single families in one LLC. So, what's the right answer? Having good insurance and good attorney, I always say.
Mhm.
But from a tax standpoint, whether they're a series or not, it's I always like to say, what's the purpose of those? And if it, as opposed to just creating a series because it sounds fun and cool.
You know, my thought on the how many LLCs for your properties has always been my risk tolerance and a dollar amount. If I form an LLC, and let's just say I don't want to risk more than $100,000, and I buy my first property and it's got 25,000 in equity, and my second one has 50,000 in equity, and my third one has 25. Well, that's 100,000. I've got 3 properties in this LLC. I'll form another one and then start stacking properties in there. And if the next 10 properties I buy have virtually no equity, I may put 10 in there because that LLC gets sued. I mean, all that you can lose is what you've got right there. Is that not right?
Correct. Or generally based on, again, if you get sued and they know that William owns it, the attorney's going to sue you and everybody in the kitchen sink and everything. But now it goes back to operating those as separate entities and establishing that those LLCs were separate and independent of each other. Then in theory, if I'm suing LLC number 2, I shouldn't be able to get the assets of number 1 or number 3 or 4 as you've separated those.
Right. Well, we all know that when you're involving a judge and lawyers, things can go sideways. I mean, you have to do asset protection with a plan in mind, and you follow that plan and hope things work. I mean, it's a little bit of luck involved, I guess. But, you know, I mean, all you can do is plan. Plans always tend to go sideways. But Sam's got a question, another vehicle question. He says, entitling a vehicle as a business expense, title it as in a personal property trust versus normal titling. Does it matter for expensing in business?
So I don't have anybody that's put a vehicle in a trust specifically. I guess I could see if it's a personal property trust that is similar to something that's set up as like a land trust. From an expense standpoint, that would just flow through to you individually. Right. Again, I'd almost have to ask with the insurance, could insurance end up costing you more because they're not seeing it as an individual, now trying to use it as an entity? But from a deduction standpoint, I'm assuming it's still going to be a disregarded entity and flow through to your personal without knowing more of the details.
Okay. Terry asked, is it better to use an LLC or trust? And, you know, I just answer that from my standpoint. I mean, you know, the trust is going to give you some privacy, but not true asset protection like that LLC will. What's your opinion on that, Frank?
So really LLCs and trusts are going to vary state by state. First off, I'm in Michigan, you're in Colorado. Each state really recognizes them differently. And then what state are you doing business in? So for instance, I live in Michigan. If William brought me a deal in Colorado, I might use a Michigan LLC to own Colorado property. I might now start falling under those 2 state laws, but that's something to consider. I personally, in a trust, more of a privacy and an estate planning vehicle, but doesn't necessarily give you that asset protection because it's revocable by nature, where that LLC is going to give you that asset protection. And there are certain states that are favorable, but again, looking at each underlying state from a tax standpoint, that LLC, if I have an LLC that owns property and William wants to invest in that, you can become a partner in my LLC pretty easily. Where with a trust, I might have a trust in place for my estate plan. You may not want to join my trust, or I may not want you to. So the LLC allows for the entrance and exit of partners a little more easily also.
Okay. All right. So Phil asked, does an LLC that has an S corporation and another LLC as members need to file its own tax return, or does the income pass through?
So the LLC has an S corporation and other LLCs as members.
Right.
So that underlying LLC would file its own tax return because it's got multiple partners.
Mhm.
Then the upper tier LLCs, assuming that they have multiple partners, would have their own tax returns. They might be disregarded entities, so there may not be tax returns at that level. Then that S corporation would have its own tax return. So it sounds like the underlying LLC would have multiple partners and be classified as a partnership for tax purposes.
Okay. Tammy asked, can you not have your LLC inside of a trust? And I'm not sure what you mean there, Tammy. Is the LLC the beneficial interest of the trust? If that's the case, yeah, sure you can.
Yeah, so the LLC partner would be the Frank Alcini, whatever trust that, and which then would flow through to my personal. And then if it's used, if it's from a privacy standpoint, probably wouldn't have my name on the trust. If it's from an estate planning, it probably would have my name on there. So, but a trust can be the partner of the LLC.
Okay. Uh, JC asks, can you speak on how to use a business trust for asset protection from which you can make purchases for business?
Such as more like a land trust, is she looking at, or?
I'm not sure exactly what she needs about what she means when she says business trust. Maybe we need a little bit more clarification on that. So, okay. Well, here's something I was really interested in. One of the points that we said we'd bring up today, and that is tips to avoid dealer status when you buy Sub2 and sell with seller financing. And, that's really a good topic. We hear that a lot about how to avoid dealer status, and different viewpoints on that. The IRS looks at intent and that sort of thing. But tell us what you think about that, Frank. If I mainly focus on that strategy, if I buy subject to and I sell with seller financing, what can I do to minimize the chances that I'm classified as a dealer?
So the biggest thing is intent,
Mhm.
and what the intent of the taxpayer is, and establishing, again, if I'm doing it personally, they're going to look through to what's my main activity. If I'm also flipping a lot of houses, I'm probably going to have a tough time saying that those sub-twos are not dealer. That's where really we're using an LLC type structure, because the biggest thing with a sub-two, if I'm a dealer, I'm going to have a sale on the date that I sell the property, and have tax consequences, plus at higher ordinary income tax rates. And but really the biggest thing is structuring your business in a way that's going to establish your intent. And that's where now having the proper LLC structure, accounting books and records, tax preparation done. Again, having that intent, it might be my wife and I have an LLC with the intent to invest in real estate. And now it's going to be a partnership that's going to report those sub-two deals, as opposed to that single member that quote unquote's a little easier, but now everything's commingled on my tax return. And I'm trying to explain to an IRS agent that property number one was sub-two, property number two was a flip, and property number three was a rental that I sold. And now I've effectively indirectly sold 10 properties that year, and I'm trying to say I'm not a dealer. Starts to really be tough to stand on that position.
Okay. So James asks, if you choose to have your LLC taxed as a C corporation, is this purely a tax designation, or would you also be expected to adhere to other C corporation formalities, such as corporate bylaws, meeting minutes, etc.?
So from the IRS standpoint, from a legal standpoint, you'd have to follow the LLC requirements. But from the IRS standpoint, they're going to look at the at the corporate requirements, having the documents in place, whether it's an operating agreement or bylaws, definitely everybody should have. A lot of states you can set up LLCs, then you can make the IRS designation without an operating agreement. But nowadays it's becoming tougher and tougher to operate without those in place. But really, as you become a C corporation, really following that structure of what's required from the IRS. Again, uh, if you're doing, depending on the level of activity, you don't need an annual board of directors if it's a single member LLC and meeting, but if it's a multi-member LLC as a C Corp, really starting to establish that, and you start running into state law rules and different requirements.
Okay. Cindy says she's already signed up for a consultation. Great. Sam says, great content, Frank. Thanks for doing this.
Oh, thank you.
I agree. Let's see. Phil Smith asks, can a disregarded LLC have multiple members?
So by nature, an LLC, a single member LLC is disregarded for tax purposes. So by nature of having multiple members, you're going to default to a partnership. So you're not going to, by multiple members, you're not going to be disregarded. Then that partnership can elect to be an S corporation or a C corporation further, if it makes sense for them. But a multiple member LLC would not be a disregarded entity.
Okay. Tanya asks, when do I need to get an EIN number for a land trust? My LLC is a beneficiary. My title company is asking for an EIN. Must I either get an EIN or show who the beneficiary is? I would say she needed a new title company personally. But anyway, what do you think about that?
So really that's more of a title company issue where the LLC, the trust, it being revocable by nature, generally is not going to have its own EIN. And a revocable trust is going to have an EIN, but that's a different animal of what we're talking about right now. But I agree with you about the title company. Sometimes it might be worth checking, but depending on what title company, I can't tell you how many times I get phone calls regarding single member LLCs that they're asking for a partnership K1, and I'm pointing to Schedule E or Schedule C and saying it's a disregarded entity, and they say, well, my underwriter says I need this, and it says LLC, so there's a K1, and I'm arguing back and forth. Right. So depending if they're more of a retail focused or if they're an investor focused title company, again, finding that investor friendly title company is going to be key.
You know, and that's why I say all the time, you guys have got to have people that are your team. You can't wait until you've got a deal, you're ready to close. You need to be lining these people up now. You need to go have a conversation with them, tell them what you want to do. You got to understand that most of these, especially, that's why I prefer working with attorneys. Attorneys are generally a little bit more flexible and they understand what's going on. Title company employees tend to just have a checklist. And when they see EIN number, man, that's a box that's got to be checked, you know, or there $15 an hour jobs in jeopardy. So that's what they want. But you got to find these people that understand what you're doing, how you want to do it. The best way to find them is to get referrals from investors that are already doing what you want to do, your local RIA, or just asking a question in the group like this. Just making a post and saying, hey, I'm in the Podunk, USA area. Can anyone recommend a good investor friendly title company? So get your team. One of the coaching calls we had just a couple of weeks ago was on building your dream team, the people that you need to get stuff done. So go down that list from that call and check off each one of those items, have those people in place so that when you need to close, they're not asking you for crazy stuff that you have to run, you know, you have to explain. You don't want to have to do that. That's standing between you and payday. And you don't want that to happen, right, Frank?
Yeah, and really having that, I mean, as you mentioned, posting in the group, because there may be somebody that, I mean, especially this last year, I think a lot of networking events have been down, but there might be someone right around the corner from you that has the greatest title company in the world, and if you don't post it, they can't let you know. Or maybe I don't have them, but I know someone that does, and I can tell you to go talk to them. So that's where having that team, because when you get to that closing table, and I always encourage clients, one thing with clients, tell them if you're going on a deal, try to call me before you get to the closing table, and don't call me on your way there. But maybe it makes sense to own it in one entity versus the other. William, you mentioned multiple LLCs. Maybe you call and say you're putting it in LLC number two, but you've already told me other things about LLC number two, and it makes sense for LLC number four to own that property. And we can strategize, because this time next year, when you're calling me, telling me what you've done, it's hard to unwind anything and fix that. I usually can just tell you what the tax consequence is, as opposed to putting it right in the first place.
Mhm. Okay. Tammy's got a question. So can Frank clarify the proper use of an LLC to not be seen as dealer status? I don't think that really matters what entity you're using, Tammy. It's more about intent and doing different types of deals in entities. I mean, you can use multiple entities, but she's asking for clarification on the use of an LLC to not be seen as having dealer status.
I think it's going to really take more facts and circumstances. So let's say I have an LLC I've had for 10 years with rental properties, and I sold I sold those just recently because great opportunities. I would say that's an investment sale. But then I used that same LLC this year and buy 3 properties that I flipped and bought for the short term, rehabbed them, sold them on the retail market. I would say those transactions are going to be in the retail or in the dealer status potentially. And then for the long term, I might change that nature of that business by default of just how I'm acting. But maybe I have 3 flips and the market changes and I get back into rentals again. So it's really, real estate is more of a parcel by parcel activity. The LLCs help you define so you don't commingle, and there might be a year that you sell 5 rentals. You're not a dealer if you've rented them for the long term, but that same year you might sell 4 flip properties. You could potentially be a dealer in that situation, just because what you were doing. So it's really the number of deals and what you're doing, but having multiple LLCs can help you differentiate your activity, of your quote unquote real estate business.
Okay. Hey, yeah, Kevin, great info again, Frank. So yeah, I totally agree. Lee Gertis is here. Good to see you, Lee. Listen, guys, if you're in Georgia and you're listening to this, Lee Gertis in Macon, Georgia, he's written hundreds of policies for me on Sub2s. He is the guy you want to talk to. He can write all over the state of Georgia. Understands trust. And not only that, if you're outside of the state of Georgia and your State Farm agent doesn't understand what you're talking about with Sub2, have him give Lee a call and Lee will explain it to him. So give Lee a call. Sam asks, thoughts on adding a member versus managing member for asset protection, single member, multi-member type LLC. And as a member only, no requirement for a K1, correct?
I'm just reading the question again.
Okay.
So it sounds like one of the members would be the manager, and then the other members would be non-managers. The K1 is going to be based on number of owners. So let's say I own 10%, William owns 90, and he's the manager. I'm still going to get a K1 in that deal. Um, I may not have any profit and loss allocated to me. That again is where LLCs give you that flexibility on that 90-10 relationship we said. that first year he might be working the deal and entitled to the first share of profits. So it might be, I only get profit on appreciation at sale. We can do structures such as that with LLCs. We have more flexibility. Something that's going to be taxed as an S corporation, you don't have that flexibility, but K1s are driven off the number of partners, not necessarily the number of managers. William and I could be partners and have an outside manager who would not receive a K1, but William and I would both receive K1s, and neither of us are managers of that LLC.
Okay, great. Matt asked, should we set up several bank accounts per flip or sub-2, kind of like Profit First recommends? Would that make tax things more complicated? I'm going to tell you, I'll answer this question before we let Frank do it, but I like to keep things simple. A minimum number of entities, minimum number of bank accounts. We use a management company to collect all of the income, and then they disperse it to the individual, where the payment goes to. What are your thoughts on that, Frank? Do you like to, I mean, it sounds like he's talking about several bank accounts per flip or sub-2. That sounds crazy.
So you could, but and it would really depend what's the purpose of the bank account. And I think one of the things in Profit First it mentions you might separate your cash account into different accounts, maybe within your accounting system. And now I take these 3 accounts, they equal my real balance. And it's almost a way, I think, to help us as Americans save and out of sight, out of mind. But if it's all within one system, you can have one account. As I mentioned, I have a client that has over 100 properties in one LLC. He has 2 bank accounts, a checking and a savings. Oh, and a money market. But that's more just investment. So I'm a fan of keep it simple as opposed to setting up these bank accounts. As you get into flips, though, really getting understanding costing, because your materials that you spend on property number 1 are different than property number 2, and allocating your cost to the proper deals. If you had them in separate bank accounts, you don't have to worry about costing, because account 1 paid for flip 1, account 2. But I'd say you'd be better off learning costing and what you're doing on your deals. You're going to become a better investor if you understand how to cost your deals versus using bank accounts.
Okay. So keep it simple, guys. Really, it's a lot easier. It's tough enough that the admin side of this business is tough enough. I mean, and I know with investors, we have short attention spans. It's like herding cats. So, it's always best to keep it as simple as possible. John asked, how do you pay a commission-only staff if you're hiring VAs or acquisitions people or whatnot to do stuff for you? What's the best way to pay those guys? I mean, I guess part of that, the IRS rules is how, they're pretty specific. Do you mandate the hours that they have to work every day? Do they work for anyone else? But tell us the law, Frank.
So, so really you get into the employee requirements with the hours and rules, and where are they? Are they coming to your place of business? A lot of times with VAs, they're working remotely with their own equipment. You probably have more of a preferred time that they're working, as opposed to they might be doing something between 9 and 10 a.m. for you. Is that really mandated? Or if their power goes out, that they're working from 9:30 to 10:30 for you? So a lot of times that commission driven would be fine to pay them, but now you get into the 1099 requirement. And are you using somebody in the US or someone offshore? Are you using a third party service? There's a lot of companies that you pay that, I pay the service, and then they pay the VA. So it really depends how you're set up. And then how much are you paying them? Because anybody you pay in excess of $600 needs to get a 1099, and you run down that road. So it'd be something really, the VAs, how are they? I have clients that use local VAs, ones that use out of state, and ones that use offshore. So each situation's a little different. If it's commission based, that they're getting a percentage of sales, it would be something to look at. And what are the dollars that we're talking about? If we're talking you're paying them $400 a year, or that they're getting 50,000 a year. So that's going to work into that discussion.
Okay. Okay, guys, it's getting close to the top of the hour. We're going to wrap up with a final question. Scott jumped on here, said he joined late. Hey, we don't hold it against you. You're here. That's what's important. He says, buying subject to, then selling with owner finance. Does renting for 1 to 2 years before the sale allow me to avoid that being dealer property? And I would say in that case, a lot of that goes toward intent. If that's what we did originally when we got started, we would sell on lease option for a year or two before we made the sale, and felt like that helped us avoid that classification. He asks, so renting it for 1 to 2 years before the sale, does that allow me to avoid dealer status on that property? Or if I do that all the time, rent for 1+ years, then sell, will the IRS tend to see through that scenario for trying to avoid dealer status? So, the IRS ain't dumb. I mean, I guess, but again, it comes to establishing intent. If occasionally that sale doesn't happen and you hold that property for a rental for longer, I guess it could be argued. What's your thought?
I would really say it's intent and what you're doing. Now, in this case, with this number of rentals turned sales, you might even start establishing more LLCs that, so each taxpayer is changing that. Maybe Frank does this often, but I'm doing it through multiple LLCs, and each intent is it was in the investment of long-term rental and investment, and it subsequently sold this asset. So it would really be what your longer term intent is and how you're structured. This might be a case to use multiple LLCs to establish that, because they're looking at a case by case. Going back to 2008 and 9, there were a lot of home builders that turned into landlords because they had property they couldn't deal with. And those, in those cases, those would have still been dealer property, when they were renting their spec homes. Then as things went south and they subsequently gave them to the bank, being dealer status helped them recognize those tax losses, because that was an ordinary loss as opposed to a capital loss that would have been limited to 3,000. So it really depends. If we see a downturn in the economy, people might want for their losers to be a dealer on that. It would offset other income. So again, you have to look at what your longer term intent is and how you're structured. I would say if your scenario, you're doing a lot of deals every 1 to 2 years, you might be using different LLCs. You're probably using different money partners to acquire those properties. And it would make sense that those are all separate, independent cases.
Mm-hmm. Okay. All right, guys, we're going to have to wrap it up. We didn't get to a lot of the questions we wanted to cover today. We had so many people participating. That's great. We certainly appreciate you. So Frank, tell everybody again how they can get the 20-minute consultation with you to talk about their tax situation and if you can help them.
Okay. Check me out on Facebook. Go to Frank Alcini, REI Tax CPA. There's a Book Now tab. You can click that, and it'll ask you a few questions just so that I have a better understanding, and then we can go from there. But definitely reach out. Some of the times I keep a little bit limited. Feel free to register. If something doesn't work, I can usually bump someone. If you see a 4 o'clock that doesn't work for you, I might be able to bump it to maybe an 8:30 or a 9 or something. I'm a little more flexible sometimes, but feel free to reach out, connect with me on Facebook, and look forward to talking to you.
Yeah. And guys, we're going to leave. We don't take these calls down, so they'll stay on here. If you're watching this after the fact and you have a question, go ahead and comment on it. And I'm sure Frank will come back, and just tag Frank in it. And I'm sure he'll come back and be glad to answer those for you and let you schedule a consultation with him too. So, hey guys, every Thursday morning we're here I'm here with Wiley, the goat behind me, for Goat Talk. So you guys join us every week. We're going to have somebody on here to talk to you guys about some aspect of real estate investing to help you with your business. And if you contribute, if you ask questions, we always have a freebie for you. We're going to be sending those out later today to everybody that commented and ask questions. It's 11 great tax tips to save you money on your taxes. And we all hate to write those checks. So thanks so much, Frank, for being here. We really appreciate you. You guys reach out to him and have a consultation with him and see if he can help you in your business. So we'll see you in the forum, and we'll see you next Thursday.
Thank you.
Thanks,
bye.
Bye-bye. Okay. I think it was great, man. We had so many questions. Everybody was commenting, and so that was fantastic.
Yeah. Thank you for having me.
Yeah. Well, I appreciate it. Listen, I don't know. Are we down yet to do a podcast?
I think April 20th.
I don't have my schedule, my book in front of me. If we're not, we need to do one. You know,
I remember when we talked, we did, and I want to say I said after April 15th.
Yeah, I think you said you were really busy. And
yeah,
also,
April 20th. For 3:30 my time.
Okay. Yeah. If we're down, then we are. Yeah, great. Let's do that. I appreciate you coming on. And it seemed like there was a lot of interest. Maybe we'll, if you're game after tax season and all, we'll come back and we'll do another one.
Okay. Yeah.
Maybe one that focuses on entities. Are you real comfortable with that as far as, structure, just structuring your business, what you should be using depending on what you're doing and that sort of thing?
Yeah. Definitely go through that. And a lot of times I defer more on what's going to make most sense for you, just because, I'm sure you see it on Facebook. Everybody's an expert, and what works best for me is the way to do it. And I'm a big proponent on a lot of the people I see even arguing. I'm thinking I've talked to 3 of those people and their situations are all totally different. That's why they're all arguing a different situation.
That's the big thing about tax advice in a general sense like this. Everybody's in a different state. They do different stuff. They have a different mix. There's not an answer that works for everybody. Okay. You have to say, okay, well, what does your business consist of? How many flips do you do? How many keepers do you hold? How much seller financing do you do? How do you acquire these things? And do you have partners? It's all different in every state and the rules and everything else. So,
And then some of the screwy deals people do with partners or money guys to get the deal done. And I always say, do what you got to do to get it working. But, your deal's different.
But some of this advice, man, I listened to some chick talking, it's been months ago now, but she was talking about how she opens a separate bank account for every property that she buys. And I said, man, we weren't friends or anything. It was in a group, but we went back and forth a couple of times, civil, but it was like, that is nuts. My God, how many checkbooks do you have?
Oh yeah.
And she got so angry because she was right. She blocked me.
Oh yeah.
She just totally blocked me. And I'm like, you tell these newbies, people getting started, it's hard enough for them to just the fundamentals of the business. When you throw in entities and taxes and bank accounts and all that stuff, that's why they never do anything, because they think they have to have everything perfect to buy a house. And I was just too stupid to think that. I just said, man, I'm going to take this Carlton Sheets course and I'm going to go buy some houses, and then tax time comes and you're like, oh no, what now? And you walk in H&R Block I had 4 houses when I went to do my taxes, and they looked at me like I was insane. I knew I had a problem.
But it's always funny. I get people, they either say they're using Excel or QuickBooks, and I said, let me see it first. And I had this one girl, she was kind of doing what you were saying with the bank accounts, and I thought, good God, she showed me her Excel sheets. They were the most beautiful thing I've ever seen. Everything made sense. Every dollar was accounted for. And I said, hey, it worked for her. It's not, I guess, the way I've done it, but she understood it. She made some money, and I can't fault her. people use QuickBooks and they think it's set it and forget it, and it's a big digital mess.
Oh, listen, QuickBooks. I remember learning QuickBooks, and it's been a while since I fooled around with it. I said, I'm not doing any of this crap anymore. But yeah, that's tough when you're not technical and you're not really savvy and all that stuff. That's a learning curve for sure.
Oh
So,
yeah.
okay.
And I mean, I like you said, it's funny, people debate, my way's the best and there is no give and I'm going to block you. And, I mean, it's funny the comments you see.
Yeah, it is. Everybody's an expert though. You know what I mean? So it
Oh
is
yeah.
legal advice and all that. So listen, all I can tell you about, all I'm going to try to tell you is what I've done for 20 years. And I may be wrong. Sometimes somebody says, did you know blah, blah, blah? No, I didn't know that. Okay, now I do. But
Oh
listen,
yeah.
a bank account for every property, that may be okay when you got 2 or 3 or 5, but when you're holding 60 or 70 houses, that can be complicated.
Oh, absolutely.
Yeah, I don't need that shit. So anyway, all right, man. All
Okay.
right, appreciate you again, and
Sounds
we'll talk
good.
soon. All right,
Have a
bye-bye.
good one. Bye.